Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar Conference, and I'm here with Jordan Farris, who's head of product development at Nuveen NuShares. Great seeing you, Jordan.
Thanks for having me, Tom.
We want to get right to the point and talk about fixed income. The Barclays Aggregate Index, which is really what a lot of advisors benchmark to for not just years, but for decades, isn't the Barclays Ag that we knew 8 or 9 years ago.
That's correct.
So how's it changed?
So since the credit crisis, it's changed, and the allocations within the Barclays Ag have gone sort of against what I think a lot of investors are looking for these days, which is yield. You know, if you look back over the past 20 or 30 years, the majority of the return from the Barclays Ag has actually been driven by the yield or the coupon that's been coming off that. And right now, we're in a period of time when the baby boomers are starting to retire, 10 to 12,000 of them per day. And they're looking for more yield in their investments. Even though rates are starting to go up, we're still at historic lows for rates. And the yield that they can get off their investments in a core fixed income portfolio may not meet their needs over the long term. They're living longer and they're entering retirement with more debt than their parents did.
Yeah, and at the same time, in the past 8 or 9 years, the maturity or the duration has gotten longer, almost twice as much, and the credit quality has declined at the same time, right?
That's exactly right. So what we want to do with the products that we've been developing is address the needs that clients are having these days in their portfolios, specifically in the core of their fixed income. We want to address the changing aggregate bond universe, and we want to be able to provide them more yield. So we're going to look at the underlying constituents, which now exist of treasuries, asset-backed securities, government-related securities, and corporate bonds. And we're going to tilt those securities and the weights of those securities towards those that yield a little bit more, so we can try to get some incremental yield to clients.
Yeah, and you've done this in creating this new index and this new ETF, NuEG NuAG, correct?
Correct.
So it's not a heck of a lot different from the Barclays Ag, but as you point out, it makes a few tweaks along the way that may enhance yield and also, to some degree, reduce some risk in some of the credit quality, would you say?
That's mostly correct. So we want to develop a portfolio that's not going to hit a home run. It's not going to disrupt the core of an investor's bond portfolio, but we want to see what sort of incremental yield that we can get out of that aggregate bond position. So we adjusted the weights of those asset classes within the aggregate bond universe, but we kept duration the same, and we changed the credit quality a little bit to that credit quality BBB that's typically generated better total returns over the long term. And from that, keeping those risk parameters pretty tight, we're able to eke out about 20% extra yield.
So in this indexing world that we're all living in and enjoying, a lot of times we spend too much time on the equity side. Here on the fixed income side, especially with the key benchmark, it's important to understand what that benchmark looks like now, and most importantly, how you might be able to make a few small changes and maybe do a little better?
Right. So what we've done is we've tilted towards those asset classes that typically have provided a little bit more yield and then maybe controlled for the duration a little bit. So within our index, you're going to get a little bit more exposure to corporate bonds, still staying in the investment grade universe, and you're going to get a little bit more exposure to securitized credit. And that keeps that duration right around where it is in the traditional aggregate bond universe.
Jordan, awesome. Really enjoyed it. Thanks for stopping by.
Thanks very much, Tom.